This video is going to cover the random walk theory and the market efficiency theory. So to start, there are two kinds of analysts in Wall Street. One is the technical analysts. Those analysts, they trying to identify undervalued stocks by searching for patterns in the past stock prices. In other words, they are watching the fluctuations in historical prices and trying to find a pattern of this price change, and then they use that to predict the future prices and to see if there is an opportunity to buy the stock or to sell the stock. So for example, just to give you an example, they may say if there is going to be a price drop for 3 days in a row for a company, then they will expect a revert of pricing going up on the fourth day. So they are just looking for those patterns and using that to identify the undervalued stocks and identify opportunities to buy or to sell the stock. However, the believers of the random walk theory will go against them. The random walk theory says the security prices change randomly with no predictable trends or patterns. Okay, statistically speaking, the movement of the stock price is random, and it's good positive over the long term because over the long run you will see the stock price is going up. Okay, the overall return from using all the historical data, there is going to be a positive return. However, the security price change is random. Okay, the keyword here is the change here. So it's not the security price is random, but the price change is random. Here is a difference. So why there is stock price change? So when there is a change, it means the market is receiving new information. Okay, so there is a good news, the stock price will go up. There is bad news, the price will go down. The price is reflecting all the available information here, and the price will change only when there is a new information arrived. Okay, new information means the information is not predictable. Okay, if you already know there's going to be a revenue drop next year, it's no longer to be a news. It's already something you know. It shall be already embedded in the price. So to make the price change, you need to get to know something you don't know before, and because it's something you don't know before, and you have no clue to predict it, and that's why the security price change is random. Okay, according to this random walk theory. So the random walk theory believers will not believe in the technical analysts. Okay? There is another type of analysts called the fundamental analysts. So those people, they attempt to find the mispriced securities by analyzing the fundamental information, such as whatever you can find on the accounting statement. They may look into the asset turnover ratio. They may look into the market share of this company. They may look into the price earning ratio. They look into those ratios and use them with the models they have, trying to find the mispriced securities. If it's underpriced, they will say it's a good opportunity to purchase the stock. If it's overpriced, they may think about shorting this stock. Okay, so they research the values of the stocks using NPV and other measurements of the cash flow. However, there is also some theory against the fundamental analysts, and that's the market efficient theory or efficient market theory. This theory says the market price, reflects all available information. Okay? And there are three different forms of it. So the weak form says the market prices reflect all historical information, and the semi-strong form says the market prices reflect all public available information, and the strong form says it reflected both the public and the private information. Okay, so the fundamental analysts, they may look into the accounting report, say the 10K report in the end of 2019, and say based on this report, this company actually doing very well. So we think this company stock price is undervalued. However, the efficient market theory, they they're suggesting that the price is already reflect the available information. In other words, if this 10K report is published or disclosed in the end of 2019, then the market already knows this information. So the market will already adjusted their price, the stock price, in the time this report being available. Okay, then there shall be no opportunity for you to see there is underprice or misprice. So in other words, the efficient market theorem says once the information is released, if the market is efficient, when there is no fluctuation in trading, the price will be adjusted very fast. So there is no use to study those fundamentals. Okay, you cannot identify new opportunities by studying those reports because it's already market available information and the market has already adjusted the price. Okay, so I'm not saying the fundamental analysts and the technical analysts are wrong, but they are just theorems against them. And they can be like right and wrong in both sides. As long as those analysts can make money, then they shall believe what they believe. And in theory, like in academia, we're just trying to study whether the market is efficient. Okay, if there, as I said before, if there is fluctuations in the market, there's illiquidity in the market, then those things will prevent the price to adjust to reflect those available information, and then the market is not efficient. Okay. So here is a few things that we find in the real world, which we call them anomalies, okay, which means the excess return you can get. So there are a few anomalies that's very famous. So there are two existing anomalies. They still exist today. One is the momentum effect. So the momentum effect says if a company, if we break all the companies by their return, by their performance, if a company is in the top ranking in the past, it's likely to do well, giving you a high return in the next time period as well. This is called the momentum effect, and this is a still existing anomaly. There is another anomaly called new issue puzzle, which says, which is found by those researchers saying if a company they newly issue the stocks, it's going to suffer from a stock price downgrade or stock price decrease in the next few years. Okay, and there are a few explanations for it. Some explanation says if the managers decide to issue new stocks, it's because they think the stock price is overpriced. Okay, so you can issue new stock at a high price, and because of that, in the next few years, it's likely the market will readjust the price and causing the stock return to go down. Okay, those two are still existing anomalies. There are some older anomalies that were found before, but they are no longer anomalies right now. One is the small firm effect, saying the small companies compared to large ones are having a higher return. And also there's the January effect, saying the stock price generally have a dip in December, and the price will go back up again in January. So that's called the January effect. And also there's the neglected firm effect, which says the neglected firms comparing to those star firms, those more researched firms, the neglected firms are having a higher return. Okay? And those three are all the anomalies, okay, which means they are no longer giving you excess return right now. And there is an interesting story here. So there is a researcher who are trying to identify all those anomalies, and he found a very interesting effect. So once the anomaly is found, and when it's published, it will going to vanish very shortly. In other words, it's evidence saying when the market realizes there is an anomaly, they will try to exploit it. There will be more people chasing down those anomalies, chasing down those effects, causing the stock price of those funds to go up. And then because the market become more efficient and because the protein price will go up, you will have less profit. Okay, so it's not saying there's no anomalies in the market, but I'm saying when there is more spotlight on those anomalies, the profits you can get is going down.